You're listening to Capital Topics, episode number 87. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkin and me, François Doyon La Rochelle, both portfolio managers with PWL Capital. In today's episode, since PWL is now celebrating its 30th anniversary, we will discuss the history of PWL with James, who is one of the co-founders. Enjoy! Good morning, James. How are you today?
Good morning to you, François. I'm very good, thank you.
Great. So today, James, we're going to discuss the history of PWL Capital, which is celebrating its 30th anniversary. We thought the best way to tackle this topic was to do a Q&A format with me asking you questions, James, as you are one of the co-founders, question about the history of PWL. So the firm was founded in 1996. So tell me, what was your vision at that time?
Well, François, we opened our doors in January 1996. We started writing the business plan in September 1995. And so we opened our doors with 7 employees, including us, the founding partners. My 2 partners and I had a vision about delivering a new value proposition that we believe could reshape the wealth management industry in Canada. So we were really setting out to build a new type of advisory firm, one without conflicts of interest and focused solely on clients. So to deliver this value proposition to clients, François, PWL, would offer fee-based wealth management with no commissions or in-house products. We also wanted to bring together money management and financial planning, creating a true one-stop shop designed to help clients reach their goals. This was the really big new idea, François. So combining the two, nobody else in Canada, so far as we knew, was doing this. But this was the way of the future. The leading edge firms in the US had already moved in this direction.
Right.
But key to this vision, we really felt clients deserved better. So with no conflicts, we were able to sit on the same side of the table as the people we served and to give them fair and honest advice.
Yeah, and at that time, James, these ideas were far from mainstream. My understanding is that the vast majority of wealth managers were compensated through commissions. So can you elaborate for our listeners on this?
Absolutely, François. Wealth managers at the time were focused on selling products with commissions attached, and their incentives were often misaligned with those of clients. Financial planning and sound allocation were really given nothing more than lip service. So although we felt the big revolution was integrated wealth management, really at the time, the notion of being fee-based in the marketplace was perceived as the real innovation.
It was very idealistic vision, wasn't it?
It was idealistic, absolutely, François. My partners, Laurent Vermelinger and Anthony Layton, the W&L and PWL, and I felt investors, as I said earlier, deserved better. So we wanted to put our clients first. Our investing approach would be based on clients' needs and disciplined long-term investing. PWL would hold itself to the highest standards of integrity, objectivity, and expertise.
And I believe this was carried through to how you reported performance results to clients.
Well, indeed, François. And this is a critical part of the PWL Capital story, because in the original business plan, we said everybody would get a professional performance report and a written investment policy statement. So we were committed to providing regular performance reporting to clients using pension plan standards. So we adopted the standards of what at the time was the Association for Investment Management and Research, which is AIMR, but it's now called the CFA Institute. And this was really non-existent in the retail wealth management space in Canada at the time. It was only about 20 years later, François, as you know, that the industry regulation required a form of performance reporting to clients.
Yeah, correct. So PWL was really ahead of the industry on that one. Clients would easily be able to see how their investments were doing. But committing to pension standard performance reporting was also a double-edged sword, wasn't it? And how did that work?
Well, Francois, we believed there was an investor appetite for this new approach. It turns out we were right. PWL Capital quickly had 7 million under management soon after we opened our doors in 96. So our pioneering approach was vindicated. This, however, didn't mean easy sailing. Despite our early success, the first years were challenging and uncertain. After paying rent and salaries, we didn't have enough left over to pay ourselves as partners for several years. So, we grew quickly, but so did the cost of operating a fast-growing firm. We needed larger premises. We had to hire more staff. We needed more technology. But we knew we had to invest in our business, even though the payoff was not immediate. We knew we had to develop an internal business culture to make our long-term growth plan sustainable.
Well, after 4 years, PWL reached its first 100 million assets under management. PWL took its first step at expansion in 1997 with an office in Ottawa, then another in Toronto in 2003. I joined PWL in 2001, so I saw firsthand how much effort this all took.
Well, yes. And so now, you're celebrating 25 years with us. And
Correct.
Congratulations to you. But
Thanks.
You will recall, I worked those first 7 years nonstop. And when I traveled across Canada or the US for industry conferences, I really thought of those trips as my vacations.
Yes. So James, we know from working with clients, the mindset of a founder/entrepreneur is a family steward. Can you explain what this means for you?
Absolutely. I mean, to the entrepreneur, employees are really like family, and we're very protective. We want them to grow. We want them to do well because they're helping us build our business. And so we feel in many ways we're responsible for supporting their professional development. So we're very proud of this. And in our case, seeing so many PWL employees build rewarding careers, and start families, buying homes with mortgages. And this is, I believe, one of our achievements for all of the PWL leadership over the years. And these leaders can be very proud of, including the current leadership.
Mm-hmm. Now, the financial markets brought their own set of challenges as well. The dot-com crash of 2000, 2002 led to a drop in assets under management. But we learned from that experience as well. We saw something during the crash that shaped a new course for PWL. Active managers had failed to outperform. I believe that this turned out to be a big blessing. What can you say about that, James?
Well, as you know, François, one of our strategic decisions was that every client would get a performance report, which means we scrutinize carefully the stocks and the portfolio managers that were hired in client accounts. And so what we discovered is that active managers failed to deliver on a very major promise. They failed to protect investors on the downside when the tech bubble burst. This revelation led us to review academic research looking for strategies that worked best for our clients for the long term. So, one of the seminal articles that we read at the time was William Sharp, economist, famous article that he wrote called The Arithmetic of Active Management. And in there, in just 3 pages, he made it perfectly clear why passive investing was the best strategy for our clients for the long term.
Well, sometimes, James, as you know, in life, timing is everything. The investment industry was launching at that time exchange-traded funds on a large scale.
Absolutely. So that was very fortuitous. And these low-fee, passively managed funds, they gave us tools that replicated the holdings of various indices globally. And again, it was playing to William Sharp's article. Instead of trying to beat the market, try and capture the capital market return. So to be more specific, with ETFs, the idea was to own the entire stock market and without making individual or security bets or sector bets or country bets. So, the best example of that is like we could, with one trade, buy the whole Canadian stock market, based on the S&P TSX Composite Index. And so with the development of these ETFs, we really now had the investment tools to easily and cost effectively implement globally diversified and very tax efficient portfolios for our clients.
While ETFs are well known now, few investors had heard of them at the time. Many didn't understand why we liked them.
That's a really good point you make, Francois, because, we take it for granted because ETFs have been extraordinarily successful. I mean, there's more ETFs than stocks now. But at the time, many felt like investing passively was doing nothing. Our competitors used to say that about us. They in some ways, they thought it was like, well, you were giving up, right? But from a marketing perspective, selling the idea of, quote, passive, unquote, investing with ETFs, sort of a bit like entering the Olympics 5,000 meter race with a weight tied around your ankle. I mean, competitors were really saying, we're not doing anything by just buying the whole market.
But academic evidence, James, showed that the stock picking and market timing were like gambling. It didn't work. These weren't reliable ways to fully benefit from the market's gains.
Yeah, so lo and behold, Francois, we embraced that bold idea that markets work. Our goal would be to deliver the expected returns that markets have to offer. But clients and prospects were really skeptical at the time. The financial services industry, as you know, even today, it's ingrained in people's mind. We can forecast the future.
Yeah. But as we often say in our podcast, no one can forecast the future. But once again, some good fortune helped us to evolve to the next level of what is now called evidence-based investing.
Yes, and evidence-based investing is really a different way of saying passive investing, and I think it's more powerful, and certainly it's easier for clients to understand. Our partner, Cameron Passmore in Ottawa, at the time, 2002, he reached out to U.S.-based author and thought leader Larry Swedroe. And, our regular listeners know we quote him often on our podcast. Larry recommended we reach out to Dimensional Fund Advisors to learn about their products they were developing in the U.S., really to capture factor-based returns. And that's a lot of jargon. But these discussions culminated with Dimensional launching their funds in Canada in 2003. And we were lead investors in these funds. I would add, Francois, that Dimensional was critically important in helping us hone our philosophy of passive investing and, significantly, to develop the messaging on how to sell this new value proposition to clients. So really, Dimensional, I think it's fair to say, Francois, became, over the years, a key strategic partner in supporting us to develop our company based on global industry best practices.
Yeah, and I would add, James, that we have been working with Dimensional since 2003, and they have excelled at identifying academic findings that can be implemented in the products that we use in our clients' portfolios. Dimensional's discipline about managing portfolios based on academic science is a critical component of how we implement our approach of buy, hold, and rebalance.
Francois, buy, hold, and rebalance is core to our success story and the long-term performance of our clients' portfolios. Our regular listeners know this approach is supported by academic research showing the value of diversification across asset classes and countries.
Yes, and as we often say, owning a well-diversified portfolio of stocks and bonds reduces risk and increases returns.
So our approach continues today to be broadly invested and diversified regardless of any one market's short-term ups and downs. This way, we give ourselves the best chances to capture the total market's winners over the long run and enjoy the incredible long-term gains markets offer.
The strategic decision after the tech bubble burst to re-engineer our investment philosophy has been repeatedly validated by new research studies over the years. In recent podcasts, we have highlighted how one remarkable study found that just 4% of stocks accounted for all U.S. stock market wealth creation above the risk-free investment treasury bills. That's from 1926 to 2003. A majority of stocks, that is 51.6% to be exact, actually had negative compound returns. In other words, slightly more than half of stocks lost money over their lifespan.
And again, Francois, this latest research really validates our strategic decision we made over 20 years ago to move to evidence-based investing. So, no one can know ahead of time which companies will be among those successful 4%. So really owning the entire market is the best way to ensure you will capture their gains. And by doing so, you give yourself the best possible chance of a successful investing experience.
Yes, according to research from PWL's Captial senior researcher Raymond Curzero, a dollar invested in a diversified international equity portfolio in 1970 would have grown to over $16 after inflation by 2024.
Yes, but that's really, very impressive. But that requires somebody buys, holds, and stays invested for the long term, Francois, as you well know.
Correct.
So I think it's fair to say that such amazing returns, they also come with a price and that price is volatility. So this is really the cost of entry for investing success. And as our colleague Raymond Curzero found in his report last year, the period since 1970 saw 6 bear markets. That is 20 plus real negative declines. And so investors should hold on to their portfolio and expect bear markets as a normal part of investing, he said. These periods are the entry price to join the club of successful long-term investors.
As we often say, James, volatility is not a bug of the system, it's normal. The research also has gotten clearer about the comparatively poor performance of actively managed funds. Studies have repeatedly confirmed our view that most active funds underperform the market. In 2025, the annual SPIVA report found that a whopping 89% of actively managed multi-cap funds underperformed the S&P 500 Composite Index over the last 20 years.
Again, the long-term evidence is that only a small portion of stocks tend to deliver most of the wealth creation of the stock market. So if those active managers aren't picking those, they're going to underperform. But as you know, François, there's no way to know ahead of time which companies will be the winners. And we like to quote Warren Buffett in our podcast, and he's widely recognized as a great stock picker. But and I quote him, "It's harder than you would think to predict which companies will be the winners and losers. And those who tell you they know the answer are usually self-delusional or snake oil salesmen."
James, PWL offers more than portfolio management services. It is a mean to a bigger end, whether it to be supporting a client's financial needs, giving to charity or community project, or leaving a legacy for the next generation. So James, over and above portfolio management, how does PWL set itself apart from the industry?
Well, Francois, I believe one of the key major competitive advantages is because of our culture of education and developing our skills constantly. We now have a cohort of very capable advisors who can deliver true wealth management, fully integrated. So, as you know, our first step with a new client is to sit with them to understand their overall goals, resources, risk capacity, risk tolerances. We review everything from tax and estate planning to insurance needs and financial objectives. With all this information, we develop an integrated plan, which will cover, tax planning, estate planning, and when required, insurance advice from external experts. So this process allows us to develop an investment plan to meet our clients' life goals. The strategy includes setting an asset allocation of stocks and bonds to ensure they have a portfolio that lets them sleep at night during the inevitable market sell-offs.
Yeah. James, as you well know, this value proposition is easy to promise but hard to deliver on consistently. You need a firm-wide culture to back it up. The original vision you had with your partners was that clients deserved better. How do you feel the firm has done over the past 30 years on this point?
Well, as I said earlier, Francois, we've always placed a strong emphasis on education, our own as advisors, for our staff, and our role in coaching and educating our clients. So, in fact, that's one of our key roles. It acting as a coach for clients in investing. What we really want is to help them minimize their behavioral mistakes. And what we've learned is once clients truly understand the long-term benefit of managing their emotions and staying the course, they're going to generate much better returns. They're actually going to capture capital market returns. And that's really the critical part of what PWL does by helping customers really feel confident in their strategy. And that allows them emotionally to maintain the discipline and stay the course through market volatility while ignoring all the noise from pundits and analysts that you get in the financial press and online.
Well, this approach to education is at the core of the PWL culture. This approach, too, is borne out by evidence. A study by the investment firm Vanguard found that advisors who use wealth management best practices can add up to 3% or more in net annual returns for clients. That added value compounds significantly over many years.
Well, again, that is a huge value add. François, as you know, the Vanguard study found that an advisor's most significant contributions is coaching investors. And as I said a little bit earlier, that's where we know we add a lot of value. So during market swings, fear and euphoria can push investors towards rash actions that undermine their plans. Our PWL culture, is really built around developing knowledgeable advisors that can help clients hold steady when markets fall and avoid overconfidence when they're rising. Given our over 20-year track record with passive portfolios, François, I can, confidently say we can demonstrate the long-term benefit of staying the course. So again, I do feel we've delivered on adding value for customers.
Mm-hmm. Yeah, our approach resonated strongly with investors, and PWL grew rapidly. By 2007, we had $600 million in assets under management, nearly double the amount of 2003. Then the financial crisis of 2007-2009 unfolded, hitting both investors and the firm hard. Assets declined then to $460 million at that time. James, can you explain to me how you dealt with that situation?
Well, François, we tightened our belts and reduced our compensation, really not wanting to let any of our team go. So our talent, our employees, that they're invaluable to us. Without our people, our capacity to serve our clients is rendered impossible. So we're really proud about the fact that we were able to avoid layoffs, and we really rode out these difficult periods. So in a sense, we were putting our investment philosophy into business practice, or remaining focused on the long term and navigating market volatility with discipline. We knew markets would recover and that our strong foundation, really positioned us well for what lay ahead when markets recovered.
Yeah. During financial crisis, portfolio managers tend to spend more time than usual speaking with clients about the markets. We need to explain the rationale behind their portfolios and reassure them about the benefits of sticking with their long-term strategy. So, James, how do we do this at PWL?
Well, François, because of our focus on education with our customers, those who've been with us a long time have learned to tune out the noise of current market volatility. So, but with, as you know, with new clients, we've got to do more hand-holding through these periods, because that's when humans really learn their true sensitivity to negative market volatility, and that's when markets drop, significantly in bear markets. So from there, our education mission, I'm proud to say, has evolved. And after the global financial crisis of 08, 09, some advisors at PWL decided to extend our education mission to the broader public. And they were quite visionary, and they saw a clear need for sharing our thinking about evidence-based investing amid it was a tsunami of poor advice and unreliable forecasts from so-called experts in the middle of that crisis.
Yeah, this is another example to me, James, how PWL with our unique culture demonstrated industry leadership, I believe.
Absolutely. Completely agree with that statement, François. In the early 2010s, our portfolio manager colleagues Justin Bender and Dan Bartolotti in Toronto started, to write investor blogs. And they were later joined by Cameron Passmore and Ben Felix with their Rational Reminder podcast. This Rational Reminder podcast is now one of Canada's most widely recognized financial education platforms. And it is really developed a strong international following as well. Our colleague, Ben Felix, who's PWL's Chief Investment Officer, also publishes a widely followed YouTube channel.
Yeah, and we must say, James, that we later jumped on the bandwagon and contributed with our own Capital Topics podcast and blog in English and Sujet Captial in French, which we started during the pandemic. The PWL online content has reached millions of Canadians, positioned PWL as an industry leader, and helped investors navigate the complexities of investing in turbulent markets. Many PWL team members have sought careers at PWL based on readings and following our online content.
Yeah, François, developing this online content has really been a big part of the firm's success. So, and I would add to that our publicly available advice really mirrors the coaching we give clients. So we walk the talk.
Yeah, we're proud of our efforts to help investors stay the course and maintain a disciplined long-term view.
François, I couldn't be more grateful when clients tell us they appreciate the PWL difference. We see the proof in our results. By 2014, we had our first $1 billion under management. Mm-hmm. Assets under management grew to $2.5 billion in 2017 and then $5.5 billion in 2025. That year, the Globe and Mail reported that PWL was one of Canada's fastest growing wealth management companies. Growth had averaged 17% annually over the previous decade, compared with an industry average of under 10%.
Yeah, and it's also gratifying to see the investing industry embrace our approach.
Indeed. In 2025, we took a big step and we partnered with Atlanta-based One Digital, a financial services group. Under this agreement, PWL Capital remains as a standalone unit in Canada with resources available, capital to accelerate our growth. Together, we're creating a firm with a broader reach, deeper expertise, and a larger platform, while staying true to the principles that made us successful. In keeping with this evolution, we rebranded in February as PWL Capital, a One Digital company. Assets under management today stand, I believe, a little over $8 billion. So this has been a really interesting development for us and for our clients.
Totally. James, can you summarize now your biggest lessons learned over the last 30 years?
Well, sure. My biggest lessons are really play the long game. And there's a famous saying, we overestimate what we can achieve in 1 year and underestimate what we can do in 10. From my end as an advisor, it's to be just that, an advisor, not a facilitator. Remain committed to ongoing education and learning. Integrated wealth management is hard to deliver, but is truly the value proposition that clients deserve. Third, François, I would say buy, hold, and rebalance really works, but think of it over 10, 20, 30 more years. What products you invest in client portfolios must align with this vision. Trading actively rarely adds value and also is very tax inefficient. And finally, I'd say don't bet against human ingenuity. When markets get scary, if you're broadly diversified, you will recover from big market drawdowns.
Mm-hmm. So as we celebrate PWL Capital's 30th anniversary in 2026, I can say, James, that I am incredibly proud of participating in the PWL story for the last 25 years. I truly believe in the values and mission of the firm. We have proven that by offering disciplined, evidence-based financial advice, clients can trust the investment plan we have developed for them.
Well, François, we've grown from an upstart boutique advisory practice to one of Canada's leading evidence-based wealth management firms. I'm very grateful to my partners over the years and our new partners, One Digital. I'm also grateful to our highly talented team and the confidence of our clients who continue to believe in us and have helped fuel our remarkable growth. Heartfelt thanks to you, François, my partner, for your great contribution and for sharing our vision. Finally, I'll say that I'm excited for the new chapters of PWL and what we will accomplish next.
Well, on that, we'll conclude. So thank you, James, for sharing your vision and history of PWL today.
My pleasure, François.
So that's it for episode number 87 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our expertise in managing your assets, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on June 17th. In the meantime, make sure to consult the Capital Topics website for our latest blog posts. See you soon. Thank you.